Three things to discuss. Number one, Morgan Stanley warns that a record U.S. profit drop is coming just down yonder, a profit drop that rivals 2008. Number two, new research shows that the biggest money managers in the world are planning on offloading over $100 billion worth of stock before year end. And folks, there's only about 8 trading days even left in 2022. And lastly, number three, we need to discuss some new indications and some new data that suggest that something could be brewing underneath the surface. Something that we haven't seen before. I will take you through all of this in today's video. All you have to do is buckle up and watch. Morgan Stanley strategist Michael Wilson came out and updated the public on their current viewpoint. They expect the S&P 500 to see further declines all the way down to potentially 3,000 for 2023. That's a 22% drop from today's levels. Now, it's worth mentioning that this analyst, Mr. Michael Wilson, is actually the same analyst that came out right before the 2022 slump and said, hey, expect a massive slump this year. But people, of course, laughed at him because you know what? Stocks only go up and Powell only print. But he said last year, hey, no, look at the different inflation data. Look at what the Fed has done historically when they got this inflation data. And then think about what that means for valuations. And he was right back then. And he's coming out this time and he's saying, hey, okay, now we're moving from the inflation problem and now we're moving into the massive earnings problem. For longer term context, though, a bottom at 3,000 would take us back to levels we first achieved back in July of 2019, which really, quite frankly, I mean, people are saying that he's extremely overly bearish, but this isn't that crazy out of the world bearish. I mean, you're still far above COVID lows and you're tracing back to that 2019 economy that had much easier money policies and where people thought at the time we were going to have years and years of consistent growth. But on the other hand, I mean, the S&P 500 is down right now about 20% year to date, and to project another 20% down coming into 2023 because of an earnings crisis, well, obviously that's a disaster. A looming earnings recession by itself could be similar to what transpired in 2008-2009, said Wilson. That could spark a new stock market low that's much worse than what investors are expecting, he wrote in a note. Now, this is the crucial prediction here. Morgan Stanley's team is now leaning towards its bear case forecast for earnings of $180 per share in 2023 compared with analysts' expectations of $231 per share. If you get $180 per share instead of $231, well, all of a sudden, all these companies, as they report earnings, well, they're going to have a ton of panic selling as analysts see their price targets or their earnings targets not met. Instead of beats, you start seeing massive underperformers. That's when you get a huge rotation out of equities overall. You pull up the data from FactSet. In dark blue, you can see the forward 12-month earnings per share, aka the predictions on where earnings are going to be. And yes, indeed, analysts have been slowly adjusting down their expectations, but barely. They still expect calendar year 2023 to have earnings growth of 5.3%. And this is despite Q4 of 2022 seeing a projected earnings decline of negative 2.8%. So think about what they are saying here, net and in effect. They are projecting that somehow as the massive rate hikes that we've already done and a few more are actually showing and having an effect within the economy, they are projecting that things are going to speed up and companies are going to become even more profitable. How do you go from declining 2.8% in the final quarter of 2022 and then all of a sudden magically in 2023 things start speeding up again, money's flowing everywhere? We're going from a year where rates were significantly lower for most of the year, and a lot of the rate hikes we've already done this year are going to start being actually impactful next year. So to expect rate hikes to actually increase earnings, to expect tightening to actually increase profitability and money flow, to me, that's kind of like believing in magic. The only way that I see this happening is if you get a massive Fed pivot or some form of fiscal stimulus from Congress, which I mean, if that happened, that would be like a direct result of an earnings bludgeon that came first. But here lies the problem. So this is the expectation of Wall Street right now. So if all of a sudden you're in Q1 or Q2 or Q3 and you're not seeing these companies report an increase in profitability, some to a very large extent, then all of a sudden it means that these companies are going to be reporting misses, and that means that there's going to be a massive rotation out of them. Now, the good news is that the S&P 500 does tend to bottom before the trough in earnings during recessions. However, the bad news is that we are barely in the beginning of the earnings drop, and many analysts don't want to even acknowledge its existence yet. So the argument that it's factored in is very much not true, in my opinion. Now, Charlie, why the heck is there such a discrepancy between analyst expectations and reality? My theory on why this is happening is because analysts that are analyzing individual companies have one-itis. They tend to look at their specific company or at most industry, and they tend to assume that their company or industry is an outlier because number one, they're executing well, or number two, maybe this year they did fine. You see this a lot with Tesla bullish analysts. They say, oh, Tesla is run well, and then their analysis doesn't even mention the macro headwinds coming to the economy, which will affect all companies, but also Tesla. And because this is done individually and people are focused on the one-itis, well, it only becomes apparent how stupid this metric is when you compile it all together onto a chart like this one. Start realizing that, wait a second, maybe it's not the best idea that analysts are only biased towards their individual companies or industries. Maybe, just maybe, they should also factor in the macro headwinds. Great and all that you have perfect execution, but your profitability is still going to go down. And then the other dynamic is that a lot of analysts just follow company guidance, and companies give guidance very, very slowly, and they're very slow to adjust downward when they have lower and lower expectations. So if analysts are using that guidance, well, they're using a very much lagging indicator, which is another reason why you're only starting to see it slow down, because you're only starting to see companies admit that things are going to get rougher and rougher. Now, I want to go ahead and move on to a massive, massive sell order that is being placed on this market. But first, a word from today's sponsor, MooMoo. Today's video is brought to you by MooMoo and the now up to 20 free stocks that you can get if you sign up and deposit using our link down below. Let's be real, in this market, the difference between success and failure is having reliable information and a powerful trading platform that has your back. And guess what? MooMoo offers you exactly that. For starters, MooMoo helps you find stocks that match your strategy with their state-of-the-art customizable screener. MooMoo helps you gain detailed insights into price action, such as with their free level 2 data that has 60 levels for bid-ask prices that provide visibility of a stock's liquidity, supply, and demand in real time. There's no delays, real-time quotes refresh every 0.3 seconds. MooMoo helps you speed up your analysis with advanced analysis and charting tools, including over 63 technical indicators and 38 drawing tools that can help you identify new trends. MooMoo also helps you stay ahead of the market with AI support alerts to help you monitor your trades and respond to price action as soon as it happens. Customizable alerts are available to give you auto notifications based on price movement and or changes in indications. MooMoo also has your back with real and human US-based customer service that are ready to answer any questions you may have during trading time. By the way, many brokers just have useless bots for customer service. Ugh. In addition to this, MooMoo is also available globally for users in the United States, Singapore, and Australia. Backed by Futu, a NASDAQ-listed fintech that has been in the finance industry for 10 years. The Futu group of companies has also obtained over 50 financial services licenses from financial regulators around the globe. In the US, MooMoo is registered with the SEC and FINRA and is a member of the SIPC, which means your funds are securely insured up to $500,000. Anyways, go ahead and give MooMoo a try today, and if you are a US-based user, you can get up to 20 free stocks. If you're an Australian user, there's another deal down there where you can get up to 110 Australian dollars cash back if you deposit about 1,000 AUD. And for a limited time, they also have a bit of a Christmas reward as well. So definitely check it out in the next couple of days. Thank you again, MooMoo, for the sponsorship. Now back to the content. Let's go ahead and talk about the massive sell orders coming in the next couple of weeks. So Benzinga just reported, quote, a recent JP Morgan and StoneX Group study has revealed that the world's most prominent money managers are in the process of unloading up to $100 billion of stocks by the end of 2022. They cited sovereign wealth funds and U.S. pension plans making these massive moves with the goal of rebalancing to reduce exposures to equities and increase exposure to bonds ahead of 2023. This reverses the trend of them actually buying equities in Q1 and Q2. Now, obviously, in a year like this one, you have a lot of both institutional investors and individual investors going and offloading shares in order to take advantage of tax loss harvesting. That way, they can use the losses to cancel out gains from maybe positions they locked in profits on during the beginning of the year. If you're somebody that bought a massive position in 2020 and sold out January of 2022, you had a huge profit on that, right? So they're saying, okay, let's go ahead and cancel out some of the taxes that we owe on that by selling off some of our losing positions. But I'm afraid this move here is a little bit bigger than that. This move to unload and rebalance before 2023 seems to be part of a more aggressive, longer-term risk tabling strategy. It's this reduced willingness to be exposed at all to equities that I think is going to become very, very apparent in the beginning of 2023. Some specific examples of this: JP Morgan mentioned that Japan's $1.6 trillion pension fund would have to sell $17 billion of equities to reach its target asset allocation. inflation. Additionally, the 1.3 trillion Norwegian oil fund could transfer 12 billion out of stocks and into bonds, and also into snowmen because it's very, very cold there during the winter. And then you go and you look at the CTA positioning here at home. Well, what are the algos positioning for? The folks over at Nomura come out with certain estimates on positioning, and they sometimes leak around social media. Now, usually I'll go and I'll show the leaked version of it. Today, I'm not going to do that. I want to respect their proprietary information. What I can show you is my interpretation and some of my conclusions from the data that I looked at. And the data, in my opinion, suggests that some of the biggest selling pressure is right around the corner and will be triggered very, very soon if certain criteria is met. The estimate suggests that there is a breaking point somewhere around that previous support at 3,500 to 3,600, which is also the year-to-date low and is all you really need to break to trigger a panic sale that takes you much, much lower. And that's also pretty basic common sense. If you're rallying from a low, you have all the sentiment traders who go and buy in thinking, oh, this could be the end of the bear market, but they aren't exactly proven wrong until you get a new low, right? And so once you get that new low, they get gut punched and run away screaming. And then you get a new level of buy and holders who are like, okay, you know what? I'm not going to hold. I'm going to go ahead and I'm going to panic sell. And then you have all the other algos that are going and dumping to accelerate the downtrend and accelerate the overall profitability that comes with shorting stocks at new and new lows. It's kind of like buying higher and higher highs. Yeah, it's unsustainable in a sense, but it's also a self-fulfilling prophecy in that if something keeps breaking out to newer and newer highs, then more and more people keep buying it. And if something keeps breaking out to lower and lower lows, well, more and more people keep selling, more and more people keep shorting, more and more people keep thinking that's going to continue. So based on my interpretation of the CTA positioning, if you see this low break, you're going to see unprecedented selling pressure to get us to another new low. When do I think it's going to break? Well, I honestly don't think it's going to break by the end of the year. I think that, yes, the selling pressure that we're seeing from JP Morgan's study, yes, I think that is going to have a negative impact because we only have like 8 trading days left, but that's still not enough to really push it down that much. I think it's going to happen probably when you start seeing those Q4 earnings reports coming in. That's going to be the first real major shock to analysts that we've seen. Everything else has kind of been like, yeah, underperforming, quiet, slow, but this, I think, is going to be the first major shock. And then from a TA perspective on the overall market, I mean, the S&P 500 and most major indices are in the clearest downtrending channel that you could possibly imagine. I mean, this is textbook technical analysis 101. You have a downtrending channel where the highs and lows consistently get lower and lower and lower. And think about what chart analysis really is at the end of the day. It's really an analysis of the evolving sentiment of participants within a market. Sentiment can bounce up and down, but the overall trend of sentiment is still bearish and has consistently become more and more bearish all year. Every single time you get any sort of rebound rally, you have to see all of these people on Twitter and the media all speculating, oh, hey, everybody that said that the market was going to go down because of record tightening, they were all wrong because we had a few week increase. Like, that doesn't always happen in every downtrend throughout history, right? Point though is all those little minor details, they're lost when you look at an overall trend, an overall channel. Sentiment can bounce up and down, but overall the trend of sentiment is what matters, and the trend is consistently more and more bearish. And usually before a trend like this, that's this aggressive and this consistent and this long-winded, before a trend like that breaks, you get a period of stagnation, a period where both the bulls and bears are at a price level where they're like, okay, wait, we're not really sure if we should sell more at this point. We're not really sure if we should buy more. So we're just going to go ahead and argue in a very, very tight range. And you just kind of bounce back and forth around that bottom. And once that's happened for a while and that debate goes on for a while, something triggers a decision. Something triggers the break out of that channel or the continuation of the overall channel. Right now, we haven't even seen that debating period. We're just straight down. We see a market that's in an overall downtrending channel and is just selling off from another temporary sentiment bounce. But on the other hand, I mean, once we do bottom, which will happen eventually, probably next year at some point, maybe mid next year, I think you're going to see a lot of insane opportunities. FinTwit posted this company heat map this morning, and there's some serious deals even now with companies like Apple, Microsoft, Alphabet, Amazon, Tesla, down dozens and dozens and dozens of percentage points. There's a lot of upside once things turn around. However, there's no guarantee that these companies will get back to their easy money policy heights anytime soon. So if you're you're somebody that is considering deploying more capital at dips, consider that the best opportunities may very well still be ahead of us, may very well still be a quarter or two out. Remember, companies tend to bottom about a couple months before their earnings trough, not when companies are just only starting to report missed earnings. Anyways, that caps off today's video. Make sure to hit that ravishing like button and subscribe and share if you saw value in it. It helps out the channel quite a lot. And of course, if you want to get up to 20 free stocks and try out an excellent trading platform, make sure to check out our link to MooMoo down below. Have a great rest of your day, folks, and we will see you in the next video.